Our next guest, Jim O'Neill, is chairman of Goldman Sachs Asset Management and was previously the chief global economist at Goldman Sachs. He also coined the term BRIC to denote the fast-growing group of emerging markets, including Brazil, Russia, India, and China. Jim, thank you so much for coming on. I wanted to get, first of all, your reaction to the Fed yesterday. It's actually the first time that we had this news conference. Yeah. Is it significant for you in general as much as it is for us?
Well, for the Fed to be copying the ECB on something is quite significant. I guess, in a slightly more light-hearted sense, that in itself is not uninteresting. It's.
But this need for transparency that Ben Bernanke wanted to actually put, does it make your job easier just to understand what's going on?
I was so busy doing various things yesterday. I wasn't gripped to the screen when it happened. I kind of, had plenty of other things to do. I think. The broader relevance of it is I think this is not just aimed at the financial markets. This is being done against the background where there's a lot of emotion in Congress about a lot of things, including the role of the Fed, and of course the unemployment consequences of the recession we've gone through puts slightly different pressures on the Fed than in the past, and so I think there's a bit of a broader thing than just for all of us guys in the markets and you guys here at Bloomberg.
Jim, in terms of what you're seeing on the markets, is it much more easy now to actually understand where everyone's going? We see, we understand that, interest rates are not going to go up. Now, yeah. A little bit easier maybe. A month and a half ago, there was so much speculation about where interest rates could go. Now we're in a bit more stable position? No? I don't see you convinced at all.
No. It's never. Let me put it like this: the first day I conclude that it's easier, the following day something's going to come out of left field. No, it's not, particularly given the power of communication and everybody knowing everything that's going on. No, it's not. If anything, it gets harder and harder because everybody's an expert every second of the day.
But let me ask you this: Are we on the path to recovery?
Definitely.
Across the world.
I think the big question right now is whether the recovery has lost a little bit of its impetus beyond the obvious consequences of the Japanese earthquake. But I mean, I've been in the camp that we're well on the way to recovery since last November, particularly as it pertains to the US. As we know, the Fed's downgraded its official central tendency, but what is more interesting is below the surface is this due to some temporary forces, again, particularly the rise in the oil price, indirectly what's going on from Japanese supply chains. Is the underlying momentum really strong? If the most valuable coincidental lead indicators I follow suggest things are still very strong, and I suspect this last wave of people pulling down their numbers on the US a little bit, I think it's going to turn out to be temporary. So amongst the reasons why it's not easier is the Fed might have a different tone if the data turns out that way in another few weeks' time, but we'll have to see.
And Jim, you're arguing that, for example, for the emerging markets, some of them should be taken out of that basket because they're growing by so much.
I'm glad you added that, because I was about to jump in and say I don't call the big ones emerging markets anymore. I think for the BRICS and for the next 11, as I call them, particular Korea, Turkey, Indonesia and Mexico, and the 4 BRICS, we shouldn't call them emerging markets. They're too important. And investors that focus on them as part of this broader group in the traditional sense, they're missing the key marginal driver of our generation, and it's silly.
You're also concerned, I guess, about China, like everyone else is. We're so dependent.
Yeah.
And you were surprised by this continuing growth despite all the government measures being put in place.
Well, if I would have been sat here 4 weeks ago, I would have said that there's pretty strong signs of a slowdown in inflationary pressures easing. I'd broadly simplify it as a sort of happy slowdown. The latest batch of data we've got from China was surprisingly strong again, and of course the CPI has come in at another new high. And that probably means the Chinese authorities have got to do more to tighten policy. And we don't quite know how these things are going to work. So in terms of on the radar of things to be slightly bothered about, that's a fresh. Because I'm always generally apparently more optimistic than most people. I'm by definition, I then say, well, what can I worry about? And,
do you worry about the fact that actually commodities, in terms of returns, commodities seem to be beating any other asset class, bonds, stocks? Is this going to continue? And what's actually driving this underlying growth?
Well, I think the reflection of really strong growth in China and the other growth markets, together with this incredibly dovish policy coming out of the Fed, is a pretty powerful cocktail for a lot of commodities. And it's all, the Fed would never admit this, and of course they don't, when they're questioned by it, they claim they're not. But in some ways, the whole of this mixed together is inducing the rally in commodities, and it carries its own dangers. But you know,
and the trend will continue. Are we going to see higher price for commodities?
I don't feel. I think there's better ways to look for the sustainable bet, including equities, because the Fed will take the foot off the gas when they see the unemployment trend so powerful that they think they won't need to be there anymore. When that happens, commodities might not enjoy themselves that much, but the earnings that go with stronger growth should keep the equity markets going. But you know, we'll see. But I'm not so sure about the commodity, how sustainable. Right now, the commodity rally looks really powerful, but
it's difficult
that's
to say.
way out there.
Yeah.
We'll, you know, come to a head before that, I'm sure.
Jim, talk to me about your day-to-day job. How difficult is it? We see on the markets what it must be reflected also on the way that your clients speak to you, risk appetite, scared of risk. Is it more difficult to get people to actually have their money with you?
Well, I think there's two general problems facing investors. First of all, the memory of 2008 lives on, and particularly a lot of individual investors saw how much you could lose so quickly. So it makes everybody very cautious in spirit and worried all the time. And then secondly, linked to the whole BRIC growth market thing, that the dynamics of the world are changing so much that there's a lack of awareness and knowledge about how to approach all these things. And so that the two things together make it very challenging, although flip side of it, very exciting. I often say to clients, it feels to me as though we're kind of living through a version of what the California gold rush must have been, because that must have been very exciting, but also very unnerving, and we didn't know the dynamics of it, and there was a lot of tensions that you read of.
But are you recapturing clients? Are they slowly coming back in or giving you more money?
Well, I think if you look at the first quarter numbers for GSAM, they were up slightly. What is clear from the breakdown is there's a marginal flow going out of money markets into equity. That's certainly what we're seeing, which is kind of rather good, because it's what I would be encouraging people to do. But then within the whole broader developed EM growth, the money is still going both in debt and equity into the growth market world, which is something, of course, I'm at the core of trying to encourage, and a big part of my platform as I go around the world chatting to people.
And so what's the question that you get asked the most, I guess, apart from will I make money?
How real is this change? Is it really all just dependent on very low interest rates in the US? There's a lot of people out there that genuinely worry that all of this new changing world looks great, but if we ever got back to a world where US interest rates would be 4 or 5%, what's the story then? And the answer
and
is,
your answer?
We don't know until we get there.
So prudence.
We'll
prudence, and I guess a diversified portfolio?
I think people have to think differently. This is why the growth market thing is so critical to my chairmanship of GSAM. We're trying to make people think differently about the world going forward than they've done in the past, and you can't treat this sort of highly risky thing called EM as something you just sort of add on when you really want to take a lot of risk. I don't think it's the right way to think about life anymore.
Jim, great to speak to you. Jim O'Neill there from GSAM. Well,